Stocks turned higher Wednesday afternoon, with investors considering the Federal Reserve's latest monetary policy decision against the backdrop of elevated inflation and a still tight U.S. labor market. The S&P 500, Dow and Nasdaq each rose and extended gains Wednesday afternoon, after Fed Chair Jerome Powell suggested future 75 basis point interest rate hikes were not currently in discussion among central bank officials. The benchmark 10-year Treasury yield rose to just below 3 points, or near its highest level since late 2018. Investors mulled the Federal Reserve's monetary policy statement, in which the central bank announced its decision to raise interest rates by 50 basis points for the first time since 2000. This increase was double the 25 basis point increase the Fed unleashed in mid-March, which itself had been the first rate hike since 2018. The latest hike brought the target range for the federal funds rate between 0.75 points and 1.00 points, compared to the current range of between 0.25 points and 0.50 points. Expectations for this supersized rate hike had been building amid market participants, especially given commentary from key Federal Reserve officials appearing to support such a move. Powell said during a public appearance with the International Monetary Fund earlier this month that he believed it would be appropriate to be moving a little more quickly on raising rates, and that 50 basis points were on the table for May. And in his post-FOMC meeting press conference Wednesday afternoon, Powell also suggested additional half-point rate hikes were also possible over the next couple of meetings. The Fed also announced Wednesday that on June 1st, it would begin quantitative tightening or rolling assets off the central bank's $9 trillion balance sheet. With this, the Fed will first allow up to $47.5 billion per month in combined U.S. Treasuries and mortgage-backed securities to run off the balance sheet. This pace will increase to $95 billion after 3 months. Heading into the Fed decision, prospects of higher interest rates have stirred up volatility in equity markets, which had grown accustomed over the past 2 years to ultra-low interest rates and generally easy money monetary policies. At the same time, however, many pundits have suggested the Fed allowed its pandemic-era supportive policies to run too long, allowing inflation to soar to the fastest rates since the 1980s. And after GDP growth turned negative in the U.S. in the first 3 months of the year, a lingering question remains whether the Fed will now be able to tighten policies without tipping the economy into a deep downturn.